now it's time for Patric Gresko of the European Investment Fund. Welcome.
Jan, thank you very much. Good morning, everyone. Thank you very much for inviting me to and giving me the opportunity of presenting the European Investment Fund. That will be the first topic of my presentation, a brief overview of who we are and what we do, and how we support, in general, the European venture capital market in Europe. The second part of my presentation will be around our specific support to the cleantech industry and what we have done so far. And finally, I'll take some 10 minutes to do an elevator pitch about our new program aiming at bringing together various stakeholders of the venture capital industry, corporations, VC fund managers, and startups. So to start with, who we are. Very simply, we are the venture capital arm of the European Union. A while ago, the European Union had decided that venture capital is one of the ways of supporting a knowledge-based economy, supporting technology-based companies in Europe, and hence they have decided to create an institution, the European Investment Fund, to support the VC activity. So we act as a fund-of-fund investor. We're not making direct investments, but we invest in venture capital funds based in Europe and who are mainly investing in Europe. Behind the European Investment Fund, there are two main European institutions, the European Investment Bank and the European Commission, who are our major shareholders, our major capital suppliers. But we have also in our shareholding structure some private and public players, which makes us a bit of a strange animal because we have a dual focus. On one side, we're policy-driven, as you understood already, but on the other side, we have financial objectives. So we have to ensure a minimum return on our investments for our shareholders. We have 12 billion under management, and 7 billion is dedicated towards early stage and growth capital. Specific support to the European venture capital. We started a while ago, nearly 15 years ago, and since 96, 97, we have grown, now to become most probably, for sure, the largest VC fund-of-fund investor in Europe. We have a portfolio of some 260 funds that we have built over the last 15, 20 years, and we have built relationship with more than 170 funds. So through our activity, we have indirectly supported more than 3,800 companies, close to 4,000 companies across Europe. We have a 99% visibility of what is happening on the market. There are very seldomly any fund manager, any funds closing without us having had a look at them. And we are present in 80% of the active funds which are on the market. It doesn't mean that we're investing in everything. It means that what is on the market most probably has had the support of EIF, but we have a rejection rate which is close to 80%. Out of the 7 billion that I mentioned earlier, 3.84 billion more or less is dedicated to funds investing in early stage and growth companies. We have developed a specialty in the assessment of first-time teams, first-time funds. So we do not only invest in established players which have a track record and who are able to demonstrate the strategy they're putting forward, but we have developed particular tools, or we call it a torture room. So we have a torture room specific for first-time funds, first-time managers, with specific tools to stress test parts of their, not bodies, but a part of their investment strategy. So why are we doing that? We're doing that because we have positioned ourselves as a quality stamp provider, and that's the feedback that we get from our co-investors. They tend to have some comfort in assessing proposals which have already gone through that torture room at EIF. With regards to the support to cleantech, we started our specific support to a pure play cleantech funds in 2006, 2007. Since then, we have built a portfolio of some 9 funds investing in the cleantech area, managed by 8 fund managers. And we have committed some 200 million since 2006. Our pipeline for this year is particularly strong. We're expecting to commit up to 5 new funds this year. Not all of them will have their first closing, but at least they will get a commitment from EF to start their fundraising. And that should amount to some 150 million euros. So we are increasing the intensity of our support to pure play cleantech funds. So far, we have backed 270 cleantech funds, cleantech companies indirectly. These companies, of course, have not been backed by the 8 funds that we have backed so far, but our traditional ICT and life sciences companies that we have backing since for 15 years had already been investing in cleantech-related companies. So our cleantech experience so far. Question is, you know that the venture capital market is suffering, is sick. We see that in the fundraising of our fund managers. The fundraising tend to be longer and longer, more and more difficult. The reason being that there is an issue around ensuring a risk commensurate return to the investors. So investors are moving away because it takes a lot of time, a lot of capital to invest before seeing the return. The question is whether the cleantech industry is facing the same issues. And with regards to the symptoms, first remark, it's maybe a bit too early to tell, too early to draw very strong conclusions. As I said earlier, we started investing in cleantech, pure cleantech funds in 2006. So the average holding period of our underlying companies is around 2.5, 3 years. So a bit too early to tell. However, there are first symptoms which are appearing, which are very similar, which are very common to the venture capital industry. It seems that it's taking a bit more time to develop the companies than initial expectations, and it's taking a bit more capital than the initial expectations. The reason for that, and that's our view at TIF, is maybe because cleantech is a very difficult industry to invest in because it is not an industry. Cleantech is an investment theme which encompasses several verticals, several industries like industrial biotech, like semiconductors, software companies, as we've mentioned earlier, energy generation, distribution. Hence, for a fund manager with a focus on early stage companies, it is very difficult to possess all the skill set necessary to analyze all these verticals, and hence that leads sometimes to some delays or longer holding periods and higher capital intensity from the underlying companies. And we're seeing that also in the stage focus of the funds. The first funds which were investing with a pure cleantech focus some 5-6 years ago, which were investing in early stage companies, are now moving their shift towards later stage companies to avoid the technological issues associated to investing in later stage. So the way forward, there are various way forwards, and I think we have mentioned that, Alois has mentioned that this morning, Richard as well. There are various ways forward which are being put in place to circumvent these issues. One of them is venture capital funds which are focusing on niche or on verticals, on specific industries, and not covering the whole cleantech spectrum. We have some representative here, Torsten, from VNT. VNT management in Finland will mainly focus on electrical systems. So that's one of the ways going forward. And then with that kind of investment proposal, it brings more comfort to investors that there is a proper link and a proper backing of the strategy by the skill set presented by the team. The other model is a more collaborative model, and drawing most probably on what have been the lessons learned from the life science industry, where fund managers have gathered around them industry experts or key players of industries to enhance their skill set and enhance their skill set and enhance their investment capabilities. So is it serious, doctor, to answer the question? I don't think so. I don't think so that it is very serious because the market has reacted very quickly. As I said earlier, the average holding period of underlying companies is only 2.5, 3 years time from the second wave of clean tech, and already measures are being put in place which look very convincing. This collaborative model, we have seen that as an opportunity for us, the European Investment Fund. As I said, we're sitting on a very, very, very large portfolio of venture capital funds, of fund managers investing in underlying portfolio companies. Such venture capital funds, how do they do that? They invest in companies which are that they need to exit within a certain period. How do they do that? They either IPO, but everybody knows that IPO is very difficult. So the second most important, or now the most important exit route is trade sales to strategic buyers, trade sale to large corporation. Hence, VC funds are looking to partner with a larger corporation in order to enhance, as I said earlier, their assessment capabilities, build early commercial partnership with their underlying companies, and basically making sure that the exit route is prepared earlier enough. On the other side of the spectrum, you have the large corporation. Richard Youngman mentioned earlier today as well, corporations are willing to access the startup community because they're realizing that innovation is happening at least as fast, if not much faster, within such startup companies than within their R&D premises. Hence, they would like to have a window of opportunity on this community of startups and have started the open innovation strategy. That's a very nice buzzword, meaning that corporations are now willing to partner with startup companies. But how do a VP of strategy and/or innovation does to implement an open innovation strategy? Think about it. We've been discussing with VP strategies and innovation, a large corporation. They're telling us, holy moly, as our English friends will tell us, how do I do to access the startup companies, the startup community in Europe? Where do I start? Do I start in the Nordics? Or are the best opportunities in Germany or in the UK? Or maybe in Benelux and France? How do I access these companies? Do I build a corporate venturing unit? And then I need to recruit a team which has sufficient skill sets in order to be able to invest in such companies. But then that means that if you have to recruit a team, you have to give them also the means to invest and create a portfolio, which costs a lot of money. The other alternative for the corporation is entering into a fund-of-fund activity. So starting by investing into funds, but then how does a corporation assess what is a proper fund? How do they make sure that the fund they're investing in is the best one? How do they make sure that they have a significant stake into that fund? And how do they make sure that they have a proper diversification of the portfolio? That's a very difficult question to answer, and this is the answer that we're aiming at providing to the large corporations. We have structured that as a very ugly fund-of-fund. So what we're proposing is to help those corporations accessing what we are good at, what we have created so far, giving them an access to our capacity of selecting the best fund managers and the most relevant fund managers for their own business, for their own strategy, and making sure that they will have a proper diversification and a privileged relationship with such fund manager. So we have structured that as a fund-of-fund, but our model goes much further than a fund-of-fund, and I will explain you why. First of all, on the fund-of-fund. This fund-of-fund has 4 investment themes, as you're seeing in my back: digital life, smart things, health and well-being, and sustainability. Sustainability is the clean tech angle, and I'll focus on that investment theme. So for the sustainability theme, we're aiming to raise 150 million euros. At that target fund size, we will provide 50 million. 100 million will be provided by corporations. Once we have gathered that money, the minimum fund size being 60 million, but once we have ensured this first closing, we'll start investing into venture capital funds, which will then invest into portfolio companies. This is a very classical fund-of-fund model. But what we have developed is a specific engagement model which goes far beyond a fund-of-fund model, which will ensure a privilege and a very efficient exchange of information between the corporates and the venture capital fund managers and the underlying portfolio companies. So each fund manager, which will be backed by this corporate innovation initiative, will commit to create what we have called an industry advisory board, an industry advisory committee, which will gather on a very regular basis, at least quarterly. And this industry advisory board will be attended only by such corporations backing the corporate innovation platform, the fund managers, and certain selected underlying portfolio companies. Discussions in this industry advisory board will not be the same as a traditional investors advisory board. In investors advisory board, we discuss about valuation of portfolio companies, FCA or EPEF compliant valuation, calculation of net IRR, and things like that, which are absolutely irrelevant for the underlying companies, but also for the corporation. So hence this industry advisory board. The second layer of the engagement model takes place at each investment team. So on a very regular basis, at least semi-annually, that's our idea for the moment, we'll make sure that the different corporations around one specific investment team would gather together in order to find synergies in their collaboration around the corporate innovation platform. And finally, at least once a year, we'll gather all corporations, all corporates investing in those 4 investment teams for giving them the platform to exchange information and exchange their experience around the corporate innovation platform. Finally, last but not least, the benefit for the corporation is not only within this corporate innovation platform, but also in what we have created so far. We will give to the corporation a privileged access to the existing fund managers, to this pool of 180, 190 fund managers. And on the other side, we'll also help our existing fund managers having an access to the new relationship that we're building with such corporation. Very often most of the time, or nearly exclusively, we're the most significant investor in the funds we're investing in. This gives us a seat in the classical advisory board of the funds. We're seeing on a very regular basis the deal flow of the fund managers. We're seeing on a very regular basis how their portfolio companies are developing. So we would be very happy to be able to raise our hand in this industry advisory board and say to our existing fund managers, listen, your company has a particular good fit with certain corporation that we have built a relationship with, and hence we can open the doors and make the link. I think this last slide concludes my presentation. Yeah, that's the last slide I was mentioning. I skipped that one. There are some 10 seconds left, so I think, Jan, we can enter into the Q&A session. Thank you very much for your attention.
Do we have a question for Patric? Konstantin in the first row.
Do you have any framework or platform for startups to choose the right VC company, VC fund within your portfolio? I mean, can ordinary startup address you directly, not some of your VC funds?
You can address us, of course, but the only input that we'll give to you is a list of funds which could have a particular interest into your own company. But
so you can help with some matchmaking, right?
Yeah.
Thank you.
Yeah, Tosmin Biewski. Patric, thank you very much for your very interesting presentation. You mentioned this new program you're just creating at the moment. Can you comment on the timeline for this program and what's the investment period of that program and so on?
Sure. So we're planning to have a first closing now in the summer. Summer extends until end of September, and that should lead us sufficient time to ensuring the first closing. As I said, we're planning a first closing with 4 corporations. The 4 of them have been, 3 out of the 4 have been clearly identified. We're finalizing the discussion with the 4th one. Hence, the investment period will start in September, October, November this year. The length of the investment period will be 5 years from that first closing.
Thank you very much.
But by the way, if you have any questions regarding this corporate innovation platform, I will be here today and tomorrow, but my colleague and friend Praveen Paranjoti will be also around and can address very well your questions.